It's a brutal thing to realize that the person most responsible for your losses isn't a hedge fund billionaire. It's the person staring back at you in the mirror. We tell ourselves the market is rigged because the alternative is too painful to swallow, that we are simply slaves to our own pulses. We stay up late chasing ghosts and cursing them, while our own anxiety quietly empties our accounts. But what if the manipulation you're so afraid of is actually happening inside your own head? In Psychology of the Stock Market, G.C. Selden strips away the charts to reveal a terrifyingly honest truth about human greed. Today, we're breaking down the 8 psychological stages of a market cycle, from the inverted reasoning that makes you buy at the top, to the speculative fever that ruins the smartest people in the room. Listen, if you drop off halfway through, you're just going to walk away with half-truths that will cost you more than you know. This is a complete psychological map. You need the full picture to stop being the prey and start being the predator. By the end of this summary, you won't just understand the market. You'll finally understand how to outsmart your own biology. So let's begin. Chapter 1. The Speculative Cycle. It's strange how we think about the market as this giant, mechanical clockwork of numbers and tickers, when really, it's just a room full of people trying not to look scared. We talk about cycles like they're some law of physics, but a cycle is just a fancy word for the way human hope eventually turns into a cold sweat. It starts so quietly. You see a price move, and for a second, you're logical. You tell yourself you're waiting for a sign. But logic has a very short shelf life when everyone around you is starting to whisper about easy money. I remember sitting in a coffee shop a few years ago, watching a guy at the next table staring at his phone. He wasn't even an investor, he was a contractor. He looked at me, eyes wide, and said he'd just made 3 months' salary in 4 days. He didn't understand the why, and the scary part was, he didn't care. That's the exact moment the cycle stops being about value and starts being about the person standing next to you. We think we're buying stocks, but most of the time we're just buying a feeling. When the market is at its lowest, when everything feels heavy and grey, that's actually when it's the most honest. But nobody wants honesty when it tastes like a loss. We wait. We wait until the sun comes out. And by the time we feel safe enough to get in, the safety is an illusion. It's the ultimate irony of this game. The more comfortable you feel, the more danger you're probably in. You see a green line going up, and your brain stops calculating risk and starts calculating what kind of car you're going to buy. It's a trick of the mind. We project the last 10 minutes into the next 10 years. Funny how peace feels boring until chaos returns. When the top of the cycle hits, it doesn't sound like a crash. It sounds like a party. It's the sound of people who have forgotten that gravity exists. Everyone is a genius in a bull market, and that's the most dangerous thing you can be. You start to think you have a system, but your system is just a mood. And then, the shift happens. It's never a loud bang, it's just a slight hesitation. A day where the news is good, but the price doesn't go up. You feel a tiny knot in your stomach, but you ignore it because your ego is already tied to the number on the screen. We tell ourselves we're different. We tell ourselves we'll know when to get out. But the market isn't a math problem. It's a mirror. If you don't know who you are, the speculative cycle is a very expensive place to find out. Most people don't lose money because the market is rigged. They lose it because they can't sit still in a quiet room. They mistake activity for progress. There's this old idea that the market is always right. I don't think that's true. I think the market is usually wrong, but it's wrong in a way that is so loud and so confident that it convinces you that you are the one who's lost your mind. It's a cycle of mental exhaustion. By the time the bottom rolls around again, the people who were screaming for joy at the top are too tired to even look at their screens. They sell right when they should be buying, not because they're stupid, but because they're human. They just want the pain to stop. And so the wheel turns, fueled by the fact that we keep forgetting how the last time felt. Chapter 2. Inverted Reasoning and Its Consequences. The human mind is a beautiful thing, but it wasn't designed to trade. It was designed to keep us alive on a savanna where if you saw everyone running in one direction, you didn't stop to ask for a balance sheet. You just ran. In the market, that exact instinct is what ruins us. We've developed this habit of inverted reasoning, where we see a high price as a reason to buy and a low price as a reason to hide. It's the only business in the world where the customers get terrified when there's a massive sale and get ecstatic when the prices are marked up 500%. I remember talking to a friend who had spent months researching a specific company. He knew their debt, their leadership, their product. He was rational. Then the price dropped 20% in a week. Suddenly, all that research evaporated. He didn't see a discount. He saw a threat. He called me sounding like he'd seen a ghost, asking if I thought the world was ending. He sold everything at the bottom. 2 weeks later, the price recovered and then doubled. He wasn't wrong about the company. He just couldn't handle the way his brain inverted the logic of the situation. He let the price tell him what the value was, instead of the other way around. It's a peculiar form of self-torture. When the news is at its absolute worst, headlines screaming about recession, debt, and disaster, that is usually the moment of maximum opportunity. But because we are social creatures, we find it almost physically painful to be optimistic when our neighbor is miserable. We look for confirmation. We want the media to tell us it's okay to buy, but by the time the media says it's okay, the opportunity is long gone. We reason from the news back to the price, but the price has already eaten the news and moved on. Most people think they are reacting to the future, but they're actually reacting to a ghost of the past. If a stock has been rising for 6 months, we convince ourselves it will rise for 6 more. We take the recent past, flip it over, and call it a prediction. It's comfortable, it's also a trap. True reasoning requires you to look at a bleak, depressing reality and see the seeds of growth, or to look at a glittering, perfect peak and see the rot starting to set in. It's lonely, and most of us would rather be wrong with the crowd than right by ourselves. It's funny how we crave certainty, yet certainty is the most expensive thing you can buy in the market. There's a quiet danger in being logical at the wrong time. If you use your intellect to justify your emotions, you're finished. You'll find 1,000 reasons why the market shouldn't be doing what it's doing. You'll say it's irrational or manipulated. But the market doesn't care about your syllogisms. It only cares about the collective weight of thousands of people acting on their own inverted logic. You have to learn to watch yourself think. You have to notice the moment your brain tries to tell you that this time is different. It never is. The names change, the technology changes, but the way a human heart beats when it's about to lose its savings is exactly the same as it was in 1910. We are just old software running on new screens, trying to convince ourselves we've finally figured out how to outrun our own shadows. Chapter 3. They. It's a word you hear in every corner of the world where money is changing hands. They are selling. They are driving the price down. They are trapping the small investors. We have this deep-seated need to believe there is a shadowy group of men in a smoke-filled room pulling the levers of the world. It's comforting, in a dark way, to think that your losses are the result of a conspiracy rather than your own lack of discipline. If there is a they, then you aren't wrong. You're just a victim. And being a victim is much easier on the ego than being mistaken. I used to know a trader who lived and breathed this. Every time the market moved against him, he'd lean back, narrow his eyes, and whisper about the big players, or the insiders. He spent more time trying to decode the secret intentions of these imaginary giants than he did looking at the actual reality of his own trades. He treated the ticker tape like a coded message from an enemy general. One afternoon, after a particularly sharp drop in the rails, he slammed his fist on the desk and yelled, "They're shaking us out!" He was convinced they knew exactly where his stop-loss was and had moved the entire global market just to take his $400. It's a form of ego-driven paranoia. We want to feel important enough that the titans of industry care about our individual shares. But the truth is much colder and much more chaotic. The market isn't a single entity with a brain and a plan. It's a mindless, shifting sea of thousands of people, all just as confused and scared as you are. Even the big players are often just reacting to one another, tripping over their own feet in the dark. There is no grand architect. There is only the collective pulse of human greed and fear. It's funny how we seek a villain to avoid looking at the person in the mirror. The danger of believing in they is that it makes you stop thinking for yourself. You start trying to play a game of second-guessing a ghost. You think, if they want me to sell, I'll buy. Or if they are pumping this, I'll short it. You cease to be an investor and become a shadow boxer, fighting an opponent who doesn't exist. You lose your ground because you've handed your power over to a myth. The most successful people I've ever met in this business are the ones who realized early on that they are just a projection of our own internal instability. When you hear people talking about the manipulators, what they're really describing is the natural movement of large amounts of capital. When a massive fund needs to exit a position, the price drops. It's not a personal attack, it's just the weather. You don't get angry at the clouds for raining on your picnic, yet we spend years being furious at the market for acting like a market. We create these monsters to explain away the fact that the world is unpredictable and that we are small within it. The real they isn't a group of bankers in New York or London. The real they is just the person you were yesterday, the one who made a plan and then abandoned it the moment things got uncomfortable. If you can stop looking for the conspiracy outside, you might finally notice the one happening inside your own head. The moment you stop worrying about what they are doing is the moment you finally start to see what the market is actually telling you. It's a quiet realization, but it's the only one that actually pays. Chapter 4. Confusing the present with the future. Discounting. There is a strange, persistent blindness that happens when we look at a ticker tape. We see the price as it exists right now, and we assume it represents what is happening right now. But the market isn't a mirror of the present. It's a photograph of a future that hasn't happened yet. It's the collective guess of millions of people about what things will look like 6 months from today. We call this discounting, but in our bones, we struggle to believe it. We see a factory closing today and we want to sell, forgetting that the smart money sold 3 months ago when the closure was just a whisper in a hallway. I remember watching a young guy in an office years ago, staring at a screen during a massive corporate earnings announcement. The company had just reported the best profits in its history. Record-breaking. The news was glowing. He bought in with everything he had, certain that such good news had to push the price to the moon. Instead, the stock plummeted. He was devastated, pacing the room, calling it a scam. He didn't realize that the market had already lived through those profits months ago. It had already celebrated, toasted the success, and moved on to worrying about the next quarter's expenses. He was buying the past, thinking it was the future. This is the hardest leap for the human mind to make. We are creatures of the now. If it's raining, we grab an umbrella, but in the market, if it's raining, you should probably be looking for your sunglasses because the market has already moved on to the next sunny day. By the time the average person feels the truth of a situation, that truth has already been stripped of its value. It's been discounted. The price is a living thing that eats information and digests it instantly. If you wait for the news to be clear, you're just paying a premium for a certainty that no longer carries a profit. It's funny how we wait for clarity before we act, not realizing that clarity is the most expensive commodity on earth. We often confuse the current atmosphere with the eventual outcome. When the world feels heavy and every headline is a dirge, we find it impossible to imagine a recovery. We think the present gloom will stretch on forever, but the market is already looking for the first green shoot under the snow. It discounts the recovery while we are still shivering in the cold. Conversely, when everything is perfect, the market is already smelling the first hint of rot. It's a constant, restless search for what comes next, leaving the rest of us to argue about what just happened. There's a quiet, almost painful patience required to master this. You have to learn to ignore the noise of today, to hear the signal of tomorrow. It feels unnatural. It feels like you're being contrarian just for the sake of it, but you aren't. You're just acknowledging that the crowd is always reacting to the shadow of the thing, while the thing itself has already passed. The market is a machine for embarrassing people who think the present is permanent. If you find yourself nodding along with the morning news, you're likely already too late. You have to train your eyes to look past the now and ask yourself, what will we be worried about when today's problems are solved? It's a lonely way to think, and it's exhausting. But the moment you stop treating the present as a map of the future is the moment you stop being the one who pays for everyone else's realization. Chapter 5. Confusing the personal with the general. There is a specific kind of arrogance we all carry, thinking that our own little corner of the world is a perfect snapshot of the entire globe. We take our personal frustrations, our local successes, or the mood of our social circle, and we project them onto the grand, indifferent canvas of the market. It's a natural mistake. We are the protagonists of our own lives, so we assume our perspective is the gold standard. But the market doesn't care about your specific reality. It doesn't care that your brother-in-law just got laid off, or that your favorite restaurant is suddenly packed every night. I remember a woman I knew who lived in a small, affluent suburb. Her town was booming. Houses were selling in hours, the local shops were thriving, and everyone she knew was feeling wealthy. Because her personal world was glowing, she convinced herself that the entire national economy was indestructible. She poured her savings into the market at the absolute peak of a bubble. She couldn't see the structural rot happening 3 states away, or the tightening of credit in the city. To her, the general situation had to be good, because her personal situation was perfect. She mistook her own backyard for the horizon. It's a dangerous form of myopia. We often find it impossible to believe in a bear market when we still have a job, or to believe in a recovery when our own bank account is still shrinking. We think our experience is the experience. But the market is a massive shifting sea of millions of individual lives, and your life is just one drop in it. When you let your personal emotions dictate your view of the general market, you aren't trading reality anymore. You're trading your own autobiography. Funny how we think we're being objective, right until our own ego gets a bruise. This confusion usually shows up most clearly in how we handle losses. If you buy a stock and it goes down, your personal pain makes you want to blame the entire system. You say the market is wrong or unfair. You take a general movement of capital and turn it into a personal insult. On the flip side, when you make a profit, you assume it's because you've mastered the general laws of finance, rather than acknowledging you might have just been standing in the right place when the wind blew. We personalize the wins and generalize the losses, when the truth is usually the exact opposite. To survive this, you have to develop a sort of healthy detachment. You have to be able to look at your own life and say, I am feeling great today, but that has nothing to do with the value of the dollar. It requires a level of self-awareness that most people find exhausting. It's the ability to step outside your own skin and look at the world as if you weren't in it. If you can't separate your personal mood from your general analysis, you'll always be the last one to see a change coming. The market is a giant machine that processes the general, but it is fueled by people who can't stop thinking about the personal. That's the friction that creates opportunity. If you can learn to see the world as it is rather than how it's currently treating you, you've already won half the battle. It's about realizing that your story is just a footnote in a much larger, much more indifferent book. Once you accept that you aren't the center of the market, you can finally start to see the market for what it actually is. Chapter 6. The Panic and the Boom. There is a point in every cycle where logic simply leaves the room. It's the moment when the collective pulse of the crowd hits a fever pitch, and we move from the realm of investing into the realm of pure, unadulterated pathology. We call these the panic and the boom, but they are really just two sides of the same coin, the total surrender of the individual to the mob. In a boom, we are intoxicated by the sight of our neighbor getting rich. In a panic, we are paralyzed by the sight of our neighbor losing everything. In both cases, the price becomes a hallucination. I remember a guy I worked with years ago during a particularly frantic bull market. He was a disciplined man, a bridge player who understood odds and risk. But as the boom reached its crescendo, I watched his discipline melt away like wax. He stopped talking about value and started talking about momentum. He bought at the very top, not because he thought the assets were worth it, but because the silence of not owning them had become louder than his own common sense. He couldn't stand the feeling of being left behind. That's the engine of a boom, not greed really, but the unbearable social pressure of missing out. A boom is a slow-motion car crash in reverse. Everything looks beautiful until the moment of impact. We convince ourselves that we've entered a new era where the old rules of gravity don't apply. But gravity is patient. When the panic finally hits, it doesn't arrive as a reasoned argument. It arrives as a scream. The same people who were hugging each other in the streets a week ago are suddenly trampling each other to get to the exit. The exit, of course, is too small for everyone to fit through at once. Funny how peace feels boring, until chaos returns. The panic is the most honest moment in the market, but it's an honesty born of terror. It's the moment when the last long holder finally gives up and throws their shares into the street for whatever price they can get. This is the capitulation. It's a dark, heavy feeling in the air, a sense that the world is fundamentally broken. But if you look closely at the history of human behavior, the panic is usually the point where the risk has actually been removed. All the weak hands have let go. The fever has broken. The problem is that our biology makes us want to sell when the panic is loudest. We think we are protecting ourselves, but we are usually just finalizing our own destruction. We sell at the bottom because we can't take the mental imagery of the number hitting zero. Conversely, we buy at the top because we can't take the mental imagery of the number hitting infinity without us. We are always chasing a ghost. The master-level secret to surviving these extremes is to realize that the crowd is always right in the short term and always wrong in the long term. The crowd can drive a price to insane heights or depressing lows, but it cannot keep it there forever. If you can learn to stand still while everyone else is running, whether they're running toward a pile of gold or away from a perceived fire, you have achieved the rarest thing in finance: emotional autonomy. It's the difference between being a leaf in a storm and being the rock the water breaks against. Chapter 7. The impulsive versus the phlegmatic operator. We like to think the difference between a winner and a loser in this game is intelligence, but I've seen some of the smartest people I know get absolutely liquidated because they couldn't control their own pulse. The real divide isn't about IQ, it's between the impulsive and the phlegmatic. The impulsive operator is someone who reacts to every flicker on the screen. They are the ones who feel a surge of adrenaline when the ticker moves a fraction of a point and feel a crushing weight when it dips. They are governed by the now, and because they are always reacting, they are always a step behind the truth. I remember a guy who worked in a firm I frequented. He was brilliant, could quote statistics and earnings reports from memory, but he was a nervous wreck. He'd buy a position, and within 20 minutes, he'd be leaning over his desk, chewing his lip, wondering if he should get out. He'd see a small sell order come through and interpret it as the start of a collapse. He was constantly doing something. He mistook his own anxiety for active management. By the end of the year, he had made hundreds of trades, paid a fortune in commissions, and ended up with less than he started with. He was a slave to his own impulses. Then there was the phlegmatic operator, a man who looked like he was napping half the time. He didn't check the prices every 5 minutes. He had a plan, he had a price, and he had a horizon. He was the phlegmatic type, cool, slow to move, and utterly indifferent to the noise of the crowd. When the market went into a frenzy, he didn't speed up. He usually slowed down. He understood that the biggest moves don't happen in minutes, but in months. He had the rarest gift in the world, the ability to be bored while everyone else was panicked. The impulsive person is a gift to the market. They provide the liquidity and the movement that the phlegmatic person eventually harvests. It's a harsh truth, but the market is essentially a mechanism for transferring money from the impatient to the patient. The impulsive operator thinks they are being fast, but they are actually just being easy. They are predictable because their emotions are predictable. If you know how a human brain reacts to fear, you know exactly what the impulsive operator is going to do next. Funny how we think doing more leads to getting more. In this world, the opposite is usually true. The phlegmatic approach isn't about being lazy, it's about being deliberate. It's the realization that most of what happens on a Tuesday morning doesn't matter for what will happen by next Friday. It's about having a thick skin for your ego. The impulsive person hates being wrong, even for a second, so they cut their winners short and let their losers run, hoping for a bounce to prove they were right. The phlegmatic person accepts that being wrong for a while is just part of the cost of being right in the end. To move from the impulsive to the phlegmatic, you have to stop looking at the market as a scoreboard and start looking at it as a weather system. You don't get angry at the wind, and you don't try to stop the rain with your bare hands. You just wait for the season to change. It takes a certain kind of humility to admit that you can't control the tape, but you can control your own hand. The moment you stop trying to outsmart the next 10 minutes is the moment you start to actually own the next 10 years. Chapter 8. The mental attitude of the individual. At the end of it all, after the charts are closed and the noise of the day has faded into that low hum of the evening, you're left with the only thing that actually matters: your own mind. We spend so much time trying to analyze the world out there, but the real work, the heavy lifting, is the analysis of the world in here. A person's success in the market isn't a reflection of their bank account, it's a reflection of their character. If you are restless, the market will find your restlessness and exploit it. If you are greedy, it will lead you off a cliff. The market is a mirror that doesn't know how to lie. I remember an old trader I met years ago, right when I was starting out. He didn't have 5 screens or a fancy office. He had a notebook and a window that looked out over a quiet park. I asked him what his secret was, expecting some complex formula or a tip on the rails. He just looked at me and said, "I learned to be okay with being alone." At the time, I thought he was being cryptic. Now, I realize it was the most practical advice I've ever received. He meant that if you can't sit with yourself in the silence, without the need for constant validation or the rush of a trade, you will always be at the mercy of the crowd. Most people approach the market with the attitude of a conqueror. They want to beat it, to tame it, to wrest a fortune from its hands. But the market isn't something you defeat. It's something you align with. Having the right mental attitude means walking that fine line between confidence and humility. You have to be confident enough to trust your own judgment when everyone else is screaming that you're wrong, but humble enough to admit the second the reality of the tape tells you you've made a mistake. Most people get those two backwards. They are humble when they should be bold, and they become arrogant exactly when they are most wrong. It's funny how we think we're looking for wealth, but what we're really looking for is the feeling of being right. To thrive, you have to detach your self-worth from your net worth. It sounds simple, but it's the hardest thing a human being can do. If a loss makes you feel like a failure as a person, you'll never be able to trade objectively. You'll hold on to a dying position because letting go feels like admitting you're less than. But a loss is just a cost of doing business. It's not a verdict on your soul. The moment you can lose money without losing your head is the moment you've truly entered the masterclass. We're all just trying to find a bit of solid ground in a world that's constantly shifting under our feet. We look for patterns in the chaos because it makes us feel safe. But the real safety comes from knowing that no matter what the market does, you have the internal discipline to stay grounded. It's about being the person who doesn't need the external world to tell them who they are. It's a strange journey, isn't it? We come for the money, but if we stay long enough, we end up finding out who we actually are. I wonder, as you listen to this, which part of your own reflection you're seeing most clearly right now. Is it the impulse to run, or the strength to stay still? If you feel like sharing a moment where the market taught you something about yourself, not about a stock, but about your own heart, I'd be interested to hear it in the comments. It's those stories that remind us we're not just trading numbers. If this conversation felt like it landed in the right place tonight, stick around. It's good to have someone else on the path who's looking for the truth beneath the noise. Be well.